Hey everybody, I'm Charting Man Dan with the Chart Guys. In this video, we're going to look at hedging, what it is, how traders and investors can use it, and then in the second half, I'm going to go over the specifics of how I personally use it to protect my long-term IRA positions. All right, quick slideshow. We're going to look at the basics of hedging in the stock market. Why do traders hedge? The different instruments and methods to do so, the pros and cons, and then we'll wrap it up with my style and examples. And in that portion, we're going to go over a bit more of the psychological aspect of hedging because there is a lot psychologically in play. And I'll share my examples as to how. So the practice of hedging for a trader, we want to protect against losses, and it requires us to take a position against our core. And that in itself is a psychological hurdle to get over. So if I've got a long-only IRA that I believe in for the next decade, I'm essentially trying to offset the inherent volatility of the stock market. We know there's going to be drawdowns of 10, 20, 30% in the stock market along the way, and I don't want to sit through that significant of a drawdown. Now, many investors, like my dad, who's now retired, did that. He sat through 2001, 2008, didn't budge, didn't do much hedging at all. He would size down a little bit, size up a little bit, but other than that, pretty much just rode those waves. And myself as a trader, I have a very difficult time just sitting through those kinds of moves. To me, that's more like a leaf blowing in the wind, where I like to be the captain of my own ship as far as, taking a bit of control. But the ways that we can hedge, it can be done through ETFs, through futures, through options. We'll look at a bit more with regards to those examples. But in reality, it lets you keep your winning position. So again, things are really extended. Do I think Microsoft's about to top for the next 20 years? No, but it might top for the next year, and just want to potentially protect against that. It acts as insurance and again offers opportunity for its own profitable trade depending on how aggressive you go or the methods that you choose. And that's the other thing, is everybody's going to have a different approach to hedging because everybody's going to have a different portfolio in terms of, what's your age, how aggressive is your portfolio, and things along those lines. So just keep that in mind, that this is a very personal situation. But again, just sharing my insight and examples for how I personally do it can perhaps give people an idea to, head down their own path and figure it out for themselves on what's best for them. So the different tools, inverse ETFs. This is the one that I use the most just because it's easy. I'm missing a Q in there. SQQQ and SPXS are the inverse ETFs where, if QQQ is going up, SQQQ is going down and vice versa. And these are also leveraged. So be aware that there is time decay in the sense that, I don't want to hold leveraged ETFs, generally speaking, for a prolonged period of time because that time decay does eventually begin to work against you. But, if I'm looking for a 2 to 4 week window, then I'm not really concerned about the time decay. Yes, there will still be some, but for me, it's an insignificant amount. It's very straightforward. That's the easiest way, right? It's a basket of stocks, and depending on how my portfolio is leaning, it's going to determine which of those instruments I choose. If I have more energy sector exposure and financial sector exposure, I'm going to look at SPXS. If I'm more tech and semiconductors, I'm going to look at SQQQ. Futures contracts, so that's a bit more complex, but there are many ways to utilize futures for hedging as well. Personally, have never done it, and not sure I ever will, but it's just a different method. And of course, options, this is more popular than futures, I would say, just in the terms of the average retail trader. They're complex as well, certainly more so than the ETFs, which are straightforward, but they allow you, to look at specific price levels and dates, and it also allows an all or nothing approach in the sense that you're saying, I'm willing to risk this $2,000 in this put contract, or however you're choosing to do it, whether you're selling calls or buying puts, but you can essentially say this is either going to go to zero, this $2,000, and then my position is going to be up a good bit more, or I will make money on this put, and that means that my core position otherwise is going down. And again, most common contracts are puts, but you can do it in multiple different ways, whether you're selling calls or not. Short positions, just straight up shorting a stock. If I'm long Tesla in an IRA, I can short Tesla in my other account, my day trading account, and offset things a bit. If I think, we're a bit extended and we're due for 10, 20% pullback, certainly Tesla has a lot of volatility and want to mute that a little bit. And again, the decisions are based on, what's your conviction level? What are your position sizes? Sometimes I'm hedging where I'm fully offsetting my portfolio. If I'm about to be out of the country on a vacation for a week and I know it's about to be volatile, I can just go flat without selling any of my long exposure by taking a fairly sizable position in some of these inverse ETFs. And I know that my portfolio is not going to move a whole lot while I'm not watching or paying attention. But otherwise, I could take a half position, and if the market's going up, then I'm still going to be benefiting, certainly less so than I would if I didn't have a hedge. But again, position sizing is another factor at play with regards to how we hedge. So should you hedge? Is it for you? Again, it depends on your position sizes, how much cash you have on the sideline, whether you're fully invested. The upside, again, risk management protects you against losses, potential for more stable returns. You can smooth out some of the volatility, and peace of mind. Again, if I'm on vacation, I don't have to think about anything because I know my portfolio is not really moving. That's valuable to me. That's worth a dollar amount. The downsides, some instruments can be complex. Again, futures and options are definitely going to require a bit more research and understanding. If those are your methods, there's always the risk of the loss, of course, and it can reduce your overall profits. If I grab a hedge and I stop out of my hedge and, take a $1,000 loss on that hedge position while my portfolio is up $3,000, then I'm obviously limiting my upside a little bit for that protection. So it is essentially as if you are paying insurance. So a little bit of background in how I hedge and the psychological burdens that I had to get over with holding long-term positions. So I've been trading for 14 and a half years, and for really the first half of it, I didn't have any long-term positions. I was a day trader. I was mostly cash overnight. I slept like a baby, and I didn't worry about significant drawdowns because I had stop losses for protection. And so I had to get over holding those drawdowns because I know that if I want long-term significant gains, any chart you look at through history, there are significant drawdowns along the way. And generally speaking, if I have a position that's going down 10% from where I had it at, that is something horrible has gone wrong. I've skipped a stop loss or I'm doing something wrong. So I had to rewire my brain saying I will have to sit through significant drawdowns. And one of the ways to protect against that was, again, grabbing some hedge positions to at least help. Because, I can be 90% sure that we're about to see daily consolidation in Microsoft. And that daily consolidation is going to lead to a 3 to 4% pullback. But I know that we're going to pull back 100 times in daily consolidation in a prolonged uptrend. And so I have to be willing to sit through that. And so one of the reasons I didn't have significant long-term positions is because I didn't have enough capital. I was trying to keep my head above water, that $25,000 pattern day trading level for a long time in my early career. And so once I accrued more capital and had cash that was sitting around and not doing anything, that's when I applied it to long-term positions that I would grab during significant fear environments, whether it's the COVID dump or 2022 bear market. And so these are some of the ways that I hedge that long-term portfolio. So when I say I'm hedging, personally, for me, that means two things. Number one, the position's in my IRA, and that helps me psychologically, have it in that spot because that's where my long-term bull positions are, and that's the account that I'm trying to offset some drawdown on. And it also means that I don't have a sell target. When I'm generally entering a trade, I have my enter price, my stop loss, and my sell target. And that's how I determine the risk and reward. Is this a good, worthwhile trade to take? But with a hedge, I don't have that target because all I'm looking to do is offset another already existing position. And I will then, play it as it comes, so to speak, and position a little bit. And I'll give an example of that in this first example. But otherwise, I'm essentially just waiting to be stopped out to know that my long positions are continuing to the upside and my net worth keeps going up, or we pull back significantly and I try and trim that position a little bit. So here's an example where Bitcoin had just run 60% to all-time highs and had not seen any meaningful weekly consolidation during that move. And so in my mind, I'm saying, all right, I know weekly consolidation is inevitable. I also know that this is a Bitcoin long-term no-touch position that I've had. And just note, when I say no touch, I don't literally mean I'm never going to touch this position. I don't ever plan on dying with any positions. That's not my goal. It just means I'm holding this position for multiple years and I will sit through significant drawdowns. And so, I'm not going to sell my Bitcoin position I've been holding since 2017 to avoid a 20% drawdown when I've already sat through two 80% drawdowns in this position to allow for the thousands of percent gains over that significant period of time. So I see a bearish doji, and I see the next day that we're confirming it with a solid red candle. And midway through that day or early afternoon, I say, all right, I want to grab a hedge. And I do so through BITI, which is, again, a bearish ETF. If Bitcoin's going down, BITI is going up. So I grabbed some short Bitcoin with BITI as a hedge to my long-term no touch for the potential of weekly consolidation. So as soon as I grab that position, if we hit a new all-time high in Bitcoin, I'm exiting. Now, I'll give a little wiggle room. I want to make sure that we break that all-time high with some follow-through, but that would tell me, okay, the bulls are still in full control, and I'm not just going to sit in my hedge position and miss out on another 10% to the upside. So as soon as I enter, it's almost like a top fishing play. I'm going off of the recent high of resistance with some wiggle room, and I'm trying to position where I get into a risk-free hedge. And this is where there's a lot of nuances. You know, if I have high conviction, I'm going to take a larger position size. If I don't have much conviction, it'll be a smaller position size. If I'm not going to pay attention to my portfolio, as I mentioned, maybe I offset the majority of it. So this is where there's the little nuances based on the individual, your risk tolerance and things like that, your confidence in your, trading and positioning ability. But let's just use the example of BITI. So after I get my entry on December 18th, Bitcoin pulls back for days and BITI goes up for days. And so let's just say, I enter middle of December 18th at $22. As soon as you get to 24 or even, upper 23s, I can sell half of that position and be risk-free. I can stick my stop under the low to that point, and that would pretty much ensure, again, there's going to be some time decay here, but that can pretty much ensure that Bitcoin needs to get a new all-time high. If I'm going to stop out of this hedge, I will lose $0 on the hedge, and my longs will continue to benefit. And if Bitcoin keeps pulling back 20, 30%, then this position is going to keep making me money and offset the drawdown of my long-term no-touch position to a certain degree. And so that is how I position very often with my hedges. I will take partial into a significant move down. And then again, very often I stop out of my hedges, break even as non-events. It's like, okay, I had a safety net. I didn't need the safety net. The longer term trend is continuing. So here's an example with QQQ where I'm hedging my long-term portfolio. And again, my long-term portfolio is mostly SPY, long-term no touch, Microsoft, multiple year swing position. So it has a little bit of a lean to the tech side of things, which is why I often will choose SQQQ as opposed to SPXS, but it depends on how I am positioned. And I'm showing you an example of one that worked out, but just know that, I stop out of my hedges plenty of times. And again, I perfectly am fine accepting that. And so here's an example where, again, the S&P 500 is all bulls. I was about to travel and be away from the computer for a couple of days. This was on July 10th. So the daily RSI is up hitting 80. The weekly RSI was up at some historical pullback levels of the recent tops. And so I just say, okay, we're all bull. We're definitely extended. And I just want to protect things a bit. And so on July 10th, grabbing a little SQQQ to hedge with the IRA a bit while I'm away for the next few days. And then stop for the SQQQ hedge is over the high of yesterday for QQQ. And I did have a target in this one to take partial profit, which was hourly oversold because, as you know, I love back burner trades and we were coming from all-time highs. And we know generally we'll see a bounce from first hourly oversold conditions. So this is the day I enter the hedge, green day. The next day, we get a pretty solid bear day. And I then just say, all right, we break the high of the previous day to new all-time highs. I stop out of my hedge. We then follow through. I take partial position off, and I can then stick my stop over the all-time high and be risk-free on that hedge position. And then obviously we pulled back very significantly from there. And I was just taking that hedge position off as we followed through. And, I didn't nail the bottom or anything like that. I scaled out a couple positions as we went. And so essentially, if the IRA, let's just go to SPY during that drop, but if the IRA would have dropped normally, 8 to 12%, because of that hedge position, maybe the IRA only dropped 5%. And again, that's one of the ways where I essentially try and stay ahead of the S&P 500 with my SPY position. So the last thing you want to be doing is constantly shorting a bull market. It needs to be spots where there's very clear low risk attempts. And so here was another one. After that V-shaped recovery in August, here's the all-time high. Look at how little risk you have taking a short anywhere at this point, just top fishing. If the resistance is 561.54, you enter a short at 558 and put your stop over the high. Another example where we follow through enough to sell a little bit, keep your stop there, you stop out, your long-term IRA keeps going. So again, my version of hedging is the very dumbed down, simple style of hedging. A lot of people, again, more complex with options and things like that. I just don't do it. It's not my primary focus. Essentially, I want to grab a little bit of a hedge position and then not really think about it. I'll sell a little bit, set my stop, and then just let it play out. And then I just keep focusing on my day trading or a vacation or whatever else is going on. So I would suggest, playing around with things a little bit to get comfortable. And again, there's just so many examples where we reject right from a clear resistance level. And again, here's, XLF, all-time high, and we reject and pull back hard, double top, and here's an all-time high, and we reject. And yes, we eventually break bull, but again, just little spots where it's low risk, grab a little bit of a hedge, and protect for the potential of a pullback. So feel free to ask any questions. I highly suggest, just playing around with things a little bit, even if it's just one share. Again, building the psychology centered around playing counter positions you think are going to go up and hold long term. That's a good way to practice and just try and pick some spots. Again, we don't want to be constantly hedging against a bullish position and just slowly eating away at our profit. We want to be a bit selective, but there are plenty of instances in the market where, especially just recently, I'm making this video here in February 2025, but, when you got a clear equilibrium like the NASDAQ and the S&P 500 have been giving us, the spots to hedge, here's your resistance, here's a rejection. I grabbed a hedge right here on this move, take a tiny bit off, and I stopped out. So again, the key is to stop out, because the last thing you want to do is, miss 10% to the upside on your long position because you didn't respect a stop with a hedge and now you don't know when to exit and things like that. But as always, it takes practice and you can get good with it. And I highly suggest at least playing around with it to see if being a little bit more active with hedging and protection is something that you want to incorporate with your trading or investing strategy.